Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at KLA.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So, we are currently watching these trillion-dollar tech giants build out basically the most complex artificial intelligence infrastructure in human history.
Right.
But none of it works if a microscopic speck of dust ruins a silicon wafer. So today we're analyzing the company that acts as the ultimate, quality control gatekeeper for the entire AI boom.
Yeah, and KLA just executed a massive 10-for-1 stock split on June 12th, 2026.
Exactly. And because of that, they've suddenly become the focal point for institutional capital trying to figure out how to play the physical manufacturing side of artificial intelligence.
It's a huge setup.
It really is. But before we break down this multi-year setup, just a quick note. If you're looking for help reading trading charts more clearly amidst all this market volatility, you can check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring visual buy and sell chart alerts, trend direction tools, support and resistance zones, and, take profit and stop loss planning areas. It works across stocks, Forex, crypto, and more.
Right, but we should remind everyone.
Oh, absolutely. Please remember, VIP Algos is an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it guarantees zero profits. Trading involves serious risk, so always manage your risk and do your own research. And that link in the description is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Okay, so getting back to KLA, it is so incredibly easy to get blinded by a 10-for-1 stock split and the endless, buzzword bingo surrounding artificial intelligence right now.
Yeah, for sure. The hype is deafening.
Right. But looking at KLA from a multi-year portfolio perspective, I think it requires stepping back. We need to figure out if this company is just a temporary beneficiary of a massive spending frenzy or if it's an actual structural wealth compounder that belongs in a long-term strategy.
I think that distinction is critical. To understand KLA's structural position, you really have to look at the unprecedented capital expenditure supercycle happening right now.
The CapEx supercycle, yeah.
Right, because KLA does not design the cutting-edge AI chips, and they don't fabricate them either.
They just build the process control equipment.
Exactly. They are basically the toll booth on the highway. When foundries are building chips at the nanometer scale, where physical features are literally the size of a few atoms, the margin for error is absolute zero.
Zero. Wow.
Yeah, so KLA provides the highly specialized inspection and metrology tools that find microscopic defects before a $50,000 silicon wafer is completely ruined. Every single semiconductor manufacturer on Earth has to use their equipment to ensure their manufacturing yields are actually profitable.
Well, that makes them foundational to the whole process, certainly. But playing devil's advocate here, cyclical tech stocks historically operate on brutal boom and bust cycles.
Oh, absolutely.
The semiconductor industry is notorious for it, right? Everyone overinvests, capacity gluts the market, capital spending halts entirely, and then the equipment makers suffer massive revenue drawdown.
Right, the semi-life cycle graveyard is full of them.
Exactly. So buying into a hardware manufacturer when everyone else is already doing it, right in the middle of a massive hype cycle, it just feels incredibly risky. Long-term investors routinely get burned buying at the absolute peak.
Well, history definitely warrants that caution, for sure. But I think the architecture of this specific build-out is fundamentally different from previous cycles.
How so?
Because we are not talking about upgrading consumer smartphones, which, ebbs and flows with consumer confidence. This is a sovereign and corporate arms race for computing supremacy.
That's a good point.
The physical limitations of silicon are being pushed so hard that foundries literally cannot manufacture these next-generation AI chips without exponentially more inspection steps.
Ah, so it's not just making more chips, it's about making them more carefully.
Exactly. KLA's revenue is decoupling from pure volume-based manufacturing cycles. It's instead being driven by process intensity. The more complicated the physics of a chip become, the more KLA equipment is completely mandatory on the factory floor.
Okay, but foundational narratives only matter if they translate directly to the balance sheet, right?
Of course.
Let's see the actual receipts on that structural strength. What do the operating numbers look like under the hood?
Well, the financials are incredibly robust. For fiscal year 2025, they generated over $12.15 billion in revenue, pulling a GAAP earnings per share of $30.37.
Over $30 a share.
Yeah, and the momentum is fully sustained. Fiscal 2026 third quarter revenue came in at $3.4 billion, which is up 11% year over year.
Okay, 11% growth is solid.
It is, but the core structural driver underneath these top-line numbers, the mechanism you really need to focus on, is their advanced packaging segment.
Ah, advanced packaging. That's the industry's solution to Moore's Law hitting a physical wall, right?
You got it.
Because for decades, they just shrank transistors to fit more of them onto a flat piece of silicon. Now, they kind of can't shrink them much further without electrons jumping the tracks.
Right, the physics just break down.
So they are stacking different chips on top of each other vertically, like floors in a skyscraper, to boost processing power and memory bandwidth.
That is the perfect way to visualize it. But stacking those chips vertically creates an absolute nightmare for quality control.
I can imagine.
You're dealing with thousands of microscopic vertical connections between those layers. If one single connection fails, the entire stacked package is completely useless.
Oh, wow.
Yeah, and because the financial stakes are so high in advanced packaging, the inspection requirements skyrocket. Management actually just raised their fiscal 2026 guidance for this specific segment to around $1.3 to $1.4 billion.
Wait, 1.4 billion just for advanced packaging?
Yep, which represents roughly 57% growth from the prior year.
57%, that's huge.
And because KLA's business model relies heavily on proprietary algorithmic software and intellectual property rather than just, bending metal, they generate massive cash flows. We're talking about over $4 billion in trailing 12-month free cash flow.
$4 billion in free cash flow usually forces a management team to make a choice. I mean, they can either try to buy growth through massive corporate acquisitions, which, let's be honest, regulators likely wouldn't allow, given KLA's massive industry footprint, or they can reward their shareholders.
Right.
How exactly is capital being allocated?
So they are returning roughly 85% of that massive free cash flow directly to shareholders.
85%.
Yeah. They recently announced a $7 billion share repurchase program alongside a 21% increase to their quarterly dividend.
So they're aggressively retiring shares, shrinking the overall float, and paying you more to hold the remaining equity.
Exactly. And this capital allocation strategy is only possible because they operate with a staggering 58% market share in semiconductor process control.
58% is basically a monopoly in tech hardware.
It is. In highly complex, cutting-edge areas like extreme ultraviolet reticle qualification, they operate a virtual monopoly.
Okay, let's clarify what a reticle actually is, because that term gets thrown around in tech circles without much context.
Yeah, good idea.
A reticle is basically the ultra-detailed stencil used to print the intricate circuitry onto the silicon. At extreme ultraviolet, or EUV levels, we're printing at the atomic scale.
Right.
If that stencil has a flaw the size of a single virus, every single chip printed with it is ruined. And KLA is essentially the only company that can reliably proofread that stencil.
Precisely.
But my skeptical side has to ask, why couldn't a well-funded, multi-billion-dollar rival just reverse engineer KLA's margins, build a good enough inspection tool, and undercut them on price?
Because the physical machine they sell is only a fraction of the actual value. KLA's true advantage is a proprietary data network effect.
A network effect for hardware.
Yes, think of it like Waze for chip manufacturing.
Okay, Waze, like
Right.
the traffic app.
Right. So if you're driving and you hit a pothole, Waze updates, and instantly every other driver in the network knows to avoid that lane.
Right, right.
Well, with KLA, every single tool operating in a fabrication plant around the world is constantly scanning and finding novel microscopic defects.
Oh, I see where this is going.
Exactly. Those tools instantly feed that data back into KLA's unified algorithmic library. If a machine in Taiwan spots a new defect caused by a specific chemical, instantly every other KLA machine in Arizona, Germany, or South Korea knows exactly how to spot it.
That's incredible.
Right. So if a competitor builds a cheaper piece of hardware, it completely lacks decades of that vital algorithmic learning. For a foundry, ripping out KLA's ecosystem to save a few $1,000,000 on equipment could end up costing them billions in ruined silicon. The switching costs are effectively insurmountable.
Okay, so if that algorithmic moat is truly that impenetrable, what is Wall Street actually anxious about in the short term? I mean, a moat tells us how they built the castle, but we need to look at what will move the needle over the next few months.
So all eyes are locked on July 30th, 2026. That is when KLA reports their fiscal Q4 earnings.
Yeah, okay. July 30th.
The entire market is waiting to see if management confirms their massive, 2027 wafer fab equipment outlook. They previously projected an environment where total industry spending on fabrication equipment could exceed $160 billion.
160 billion.
Yeah. If management validates that massive number on the earnings call, it effectively locks in the thesis for this multi-year infrastructure supercycle.
We have to factor in the broader macroeconomic environment, though. I mean, May's headline consumer price index came in hot at 4.2%.
True.
Typically, when inflation runs hot and the prospect of interest rate cuts basically evaporates, highly valued growth and tech stocks get severely punished. The cost of capital goes up, and future cash flows are heavily discounted.
That macroeconomic pressure is usually a death knell for cyclical tech. You're absolutely right. But the market is treating this specific artificial intelligence build-out as entirely inflation agnostic.
Really, inflation agnostic.
Yes. The major cloud providers have decided that falling behind in AI computing power is a literal existential threat to their businesses. They are going to spend the capital on these data centers regardless of whether interest rates sit at 4% or 6%.
Wow.
Consequently, KLA is largely insulated from the traditional macroeconomic downgrades that usually hit when inflation spikes.
That makes sense. Let's address the corporate action from June 12th, 2026, though, the 10-for-1 stock split.
Ah, yes.
Mathematically, stock splits do absolutely nothing to the intrinsic value of a company. You are taking the exact same underlying business and just slicing it into more pieces. The balance sheet remains identical.
Right. It's the exact same pie.
Exactly. So is the market just riding a temporary wave of retail liquidity here?
Well, from a purely mathematical standpoint, the intrinsic value remains completely unchanged. But, market mechanics play a massive role in price discovery. By taking a nominal share price from well over $2,000 down to the $250 range, you dramatically alter retail accessibility. And more importantly, it makes the options market vastly cheaper and highly liquid.
Ah, the options market.
Exactly. This psychological and liquidity-driven momentum can sustain an upward trajectory far longer than traditional fundamental analysis might dictate.
Looking at the actual price action post-split, what is the tape signaling right now?
So on the day the split became effective, June 12th, KLA closed at $253.84. But the context you need here is the pre-split momentum. Over the past trailing year, the stock surged roughly 170%.
A 170% run for a large-cap industrial technology company is a massive expansion. That usually means the valuation rubber band is stretched to its absolute breaking point.
Oh, the tension is certainly there, and the options market is pricing in significant future movement.
Yeah.
Right now, options implied volatility is sitting at the 100th percentile of its one-year range.
Whoa. We need to unpack what implied volatility at the 100th percentile actually means in practice.
Yeah, let's do that.
Because implied volatility is the options market's forecast of a likely movement in a security's price. When a stock moves 170% in a year, the market knows a major reversion or an explosive breakout is coming.
Exactly.
Options writers demand a significantly higher premium because the risk of a massive swing is huge. Hitting the 100th percentile means options contracts have literally not been this expensive to buy in the last 12 months.
Yep.
The market is bracing for a violent directional move. If you're a short-term trader, you're basically stepping onto a battlefield.
It's extremely chaotic.
And navigating an environment where a stock could swing that wildly is incredibly difficult. That specific need to filter out the chaos and find actual structural support zones is exactly why traders rely on clean charting workflows. Which, honestly, ties back to why people use indicator tools like VIP Algos to visualize where institutional buyers and sellers are actually stepping in.
High implied volatility absolutely requires stripping out emotion and looking at the raw price structure. And the tape shows KLA continuously grinding higher with very shallow dips.
Shallow dips.
Yeah, every time the stock experiences even a minor pullback, institutional buyers are aggressively stepping in to accumulate more shares, steadily establishing higher support levels.
So how is Wall Street reacting to these wild technical setups? Are analysts intimidated by a chart that is up 170% with maximum implied volatility, or are they still aggressively pushing this thesis?
They are overwhelmingly aggressive on the long side. I mean, Cantor Fitzgerald recently set a price target equivalent to $2,500 pre-split, driven entirely by their conviction in this sustained multi-year AI upcycle.
2,500, wow.
And we are seeing serious institutional capital flowing in to back that up. Billionaire investor Dan Loeb at Third Point doubled down on his KLA position in the first quarter, explicitly stating that semiconductors remain his top sector pick.
I'm also hearing serious noise regarding passive index inclusion. With the market cap expanding into the $250 billion range, KLA is suddenly knocking on the door of megacap index territory.
That passive flow is a massive structural tailwind.
Mm.
Most people just don't realize how mechanical the stock market is today. A huge portion of global wealth is sitting in passive index funds.
Right.
If a committee decides to increase KLA's weighting or add them to a major megacap index, every single passive fund tracking that index has to go out and blindly buy millions of KLA shares the very next morning.
They don't even look at the price.
Exactly. They don't look at the chart. They don't care about implied volatility. They just buy. That creates a mechanical price-insensitive floor under the stock.
Okay, but here is my main issue with the current sentiment. I frequently see KLA pop up on quantitative financial screens categorized as an affordable growth stock.
Yeah.
That label feels like a massive oxymoron to me. How can anyone justify calling a stock trading at a significant premium multiple, which is up 170% in a single year, affordable? It feels like analysts bending the math to justify chasing the absolute top.
It definitely sounds contradictory until you look at the velocity of their earnings.
The velocity.
Yeah. The price-to-earnings multiple is elevated, but KLA is delivering an astonishing 26.37% earnings per share growth rate.
Okay, almost 27% growth.
Right. And when your bottom line profitability is compounding that rapidly, it compresses the forward valuation multiple incredibly fast. If they continue to execute against those growth targets, investors are essentially paying a mathematically fair premium today for an exponentially larger stream of future cash.
I see.
That is exactly why algorithmic models still view the stock as growth at a reasonable price, rather than just blind speculation.
Well, we have outlined a very strong thesis covering impenetrable algorithmic moats, inflation resistance, and structural supercycles. But we have to force a reality check.
Always.
Sentiment is great, but what could completely derail this thesis? What is the actual bear case?
The most immediate threat is pure valuation risk. KLA is currently trading roughly 10% above most consensus price targets.
Okay, so it's priced for perfection.
Exactly.
Yeah.
That means absolute perfection is already priced into the stock. Going back to that July 30th earnings date, if management delivers even slightly conservative forward guidance, say they project that 2027 wafer fab equipment spending might only hit $140 billion instead of the expected $160 billion, the stock will face a violent immediate contraction.
Zero margin for error.
There is zero margin for error.
Let's talk about their physical operations. They possess an incredible software and data moat, but at the end of the day, they still have to manufacture and assemble highly complex physical machinery.
Right, and that introduces the second major operational risk, margin compression.
Margin compression.
Yeah. KLA is currently absorbing a 100 basis point hit to their gross margins. Their costs for the highly specialized memory components used inside their inspection tools are soaring. Right now, management is choosing to absorb those increased costs internally rather than passing them on to their foundry customers.
A 100 basis point hit is a 1% contraction, which might sound like a rounding error to someone on the street.
Yeah, it does.
But when a company is doing over $12 billion in revenue, that represents a massive hit to profitability. And let's look at why that is happening. KLA builds machines that process petabytes of visual data to find these atomic defects.
Right.
To process that data, their machines need the exact same high bandwidth memory chips that the AI server farms are hoarding. So KLA is bidding against Amazon and Microsoft for these components, and their supply chain costs are skyrocketing. Eating those rising costs right at the peak of the greatest infrastructure spending spree in history is a major red flag. If the capital expenditure from their clients slows down even a fraction, and KLA is simultaneously taking a profitability hit, I mean, that is a toxic combination. You do not want contracting margins at the top of an industrial cycle.
It is a totally critical pressure point, and it's the primary reason conservative funds might hesitate here. However, context is key.
Okay.
Even after absorbing that 100 basis point hit, KLA is maintaining gross margins above 60%.
Above 60% on hardware.
Yes, that is software as a service level profitability on massive, heavy industrial hardware. Management's long-term operating models are still targeting 63 to 64% gross margins.
So they aren't overly worried yet.
No, they are deliberately choosing to eat the cost today to protect their customer relationships and heavily defend that 58% market share, fully anticipating that their pricing power and sheer scale will allow them to outgrow this temporary headwind in the coming quarters.
Bringing all of these dynamics together, um, the structural necessity of advanced packaging, the ways like data moat, the stretched valuation, and the margin supply pressures. Right. So with everything on the table, what's the final verdict on KLA?
Evaluating the fundamentals against the risks, KLA earns a solid bullish score of 8.5 out of 10.
8.5.
Yeah. The official stance here is a multi-year hold. They are the ultimate toll bridge for the entire artificial intelligence semiconductor build-out. With advanced packaging revenues exploding and clear visibility into the massive 2027 spending environment, they're incredibly well-positioned to compound capital.
Right.
But to be completely clear, remind listeners, this rating and analysis is strictly for educational purposes. It is not financial advice, and you must manage your own portfolio risk, particularly when a stock is trading at these premium levels.
Absolutely. And if you are an active market participant looking to map out high volatility environments, be sure to check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite designed to provide visual buy and sell alerts, trend direction tools, support and resistance zones, alongside take profit and stop loss planning.
It's super helpful.
It is, but remember, it is purely an educational chart analysis tool. It is not financial advice, it does not execute trades for you, and it guarantees zero results. Trading involves risk, so always conduct your own research and manage your downside. We do earn a commission if you use that affiliate link at no extra cost to you.
And if this episode helped you better understand the mechanics driving the market, please consider subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.
Before we go, I want to leave you with one final thought to mull over independently. We discussed how process control intensity is continually rising. Industry speculation suggests it could actually breach a speculative 8.5% of total wafer fab equipment spending by the end of 2026. If the physical limitations of these next-generation AI chips continue to break our current manufacturing paradigms, will foundries eventually be forced to allocate 10% or even 12% of their multi-billion-dollar budgets exclusively to inspection and quality control? If chip complexity keeps breaking the laws of physics, they might just have to rewrite the long-term models entirely.